Silver prices advanced above $80 per ounce in mid-February 2026, representing a recovery from the 76th level reached during the early February decline. Gold traded above $5,000 during the same period. The gold-to-silver ratio, which measures the number of ounces of silver required to purchase 1 ounce of gold, declined to approximately 62.1 as silver prices rose faster than gold on a percentage basis. Several financial institutions published research forecasts projecting silver price ranges for 2026, while government officials made statements regarding potential policy frameworks for critical minerals. This analysis examines the confirmed price movements, the mechanics of the gold-silver ratio, institutional forecast methodologies, government policy discussions, and the range of conditions that could influence silver market dynamics. The analysis will proceed in 5 parts. First, the confirmed price data and gold-silver ratio movements. Second, the historical context for gold-silver ratio levels and their interpretation. Third, institutional forecast methodologies and the distinction between forecasts and outcomes. Fourth, government policy discussions regarding critical minerals and their potential market implications. Fifth, scenario mapping based on different paths for geopolitical conditions, institutional demand, and policy implementation. Silver prices traded above $80 per ounce during mid-February 2026, following a period of volatility that saw prices decline from January highs above $100 to lows near $76 in early February. The recovery from $76 to above $80 represented approximately 5% appreciation. Gold prices during the same period traded above $5,000, representing continued strength in precious metals broadly. The gold-to-silver ratio at approximately 62.1 reflected the relationship between gold at $5,000 and silver at approximately $80.81. This ratio represents the number of silver ounces required to equal the value of 1 gold ounce. The ratio declined from higher levels during periods when silver prices rose faster than gold prices on a percentage basis. For example, if gold rises 2% while silver rises 4%, the gold-silver ratio compresses as silver outperforms. Historical gold-silver ratios have ranged widely depending on market conditions, monetary systems, and relative supply-demand dynamics. During periods when both metals served as monetary standards, ratios often ranged between 15:1 and 20:1, reflecting historical mint ratios and natural occurrence proportions. Following the shift to fiat currency systems, the ratio showed greater variability. During the 1980 precious metals peak, the ratio reached approximately 15.1 as silver rallied more aggressively than gold. During silver weakness in the 1990s, the ratio exceeded 80.1 and at times approached 100.1. In the 2008-2011 period, the ratio compressed from 80.1 to below 40.1 as silver advanced from $10 to nearly $50, while gold rose from $800 to $1,900. The subsequent silver decline from $50 to $14 during 2011-2015 saw the ratio expand back above 80.1. The 2020-2021 period showed ratio compression as both metals rallied, followed by expansion during 2022-2023 as silver declined while gold remained relatively stable. The interpretation of gold-silver ratio movements involves understanding that ratio compression typically occurs when silver rises faster than gold, while ratio expansion occurs when silver falls faster or rises slower. However, the ratio itself does not predict future movements, but rather describes current relative pricing. Lower ratios indicate silver is relatively expensive compared to gold on a historical basis, while higher ratios indicate silver is relatively inexpensive. At 62:1, the current ratio sits near historical median levels rather than extreme highs or lows. This suggests neither extreme relative value nor relative overvaluation compared to the full historical range. However, comparison to specific periods rather than the full historical range can yield different interpretations. Compared to the 15.1 ratio at the 1980 peak, current levels show silver substantially cheaper relative to gold. Compared to the 80-100.1 ratios of the 1990s or early 2000s, current levels show silver relatively expensive. Silver's market capitalization calculation involves multiplying the estimated above-ground silver supply by current prices. Estimates of above-ground silver stocks vary, but approximations suggest roughly 2 to 3 billion ounces exist in identifiable forms, including investment bars and coins, jewelry, industrial stockpiles, and exchange-traded product holdings. At $80 per ounce, this represents approximately 160 to 240 billion in total market capitalization, depending on the stock estimate used. Comparing this to corporate equity market capitalizations requires noting that equity market caps represent ownership claims on ongoing businesses with earnings, while commodity market caps represent the total value of physical stocks. NVIDIA's market capitalization exceeded $2 trillion at various points during 2025-2026, substantially larger than silver's total market cap. However, commodity market caps and equity market caps serve different economic functions and respond to different factors. Several financial institutions published research notes containing silver price forecasts for 2026. JPMorgan analysts projected silver could reach $85 per ounce, with an average price of $81 for the year. Goldman Sachs analysts forecasted a 2026 average between $85 and $100 per ounce. These institutional forecasts reflect analyst assessments based on their models incorporating supply-demand projections, macroeconomic conditions, industrial consumption estimates, and investment demand assumptions. Institutional forecast methodologies typically combine fundamental analysis of supply-demand balances with technical analysis of price patterns and macroeconomic modeling of factors affecting commodity prices. Supply analysis examines mining production forecasts, recycling flows, and inventory changes. Demand analysis evaluates industrial consumption trends, jewelry demand, and investment flows. Macroeconomic analysis incorporates interest rates, inflation expectations, currency movements, and economic growth projections. The accuracy of commodity price forecasts varies substantially. Forecasts made at the beginning of a year frequently require revision as actual conditions evolve differently than anticipated. Industrial demand may grow faster or slower than projected. Investment flows respond to events that were not predicted. Supply disruptions occur unexpectedly. The uncertainty inherent in these projections means that actual prices frequently diverge from forecasts, sometimes substantially. The distinction between forecasts and actual outcomes requires emphasis. When analysts project that silver could reach a certain level, this represents a possibility under specific conditions rather than a certainty. When average price targets are given, these represent central estimates around which actual prices may vary significantly. Historical evaluation of forecast accuracy across multiple years and multiple forecasters shows wide dispersion between predictions and outcomes. Annual average silver prices provide one metric for assessing market conditions across a year. The 2026 year-to-date average through mid-February would reflect the prices from January and early February. If January saw elevated prices followed by February decline and recovery, the average would fall between the extremes. Calculating an annual average requires waiting until the year completes, as subsequent months will affect the final calculation. The concept of an interim price floor or support level reflects technical analysis methodology, where certain price levels appear to attract buying interest that prevents further declines. The characterization of $64 as a potential interim floor would be based on observation that prices found support near that level during recent corrections. However, support levels are probabilistic rather than absolute. Prices can and do break through support levels if selling pressure exceeds buying interest at those levels. Government policy discussions regarding critical minerals reflect strategic considerations about supply chain security and domestic production. United States government officials have made statements indicating that agencies are examining mechanisms to support domestic critical mineral production. Such mechanisms could theoretically include price floors, production subsidies, strategic stockpile purchases, or regulatory frameworks favoring domestic production. The concept of a price floor mechanism would involve government commitment to purchase minerals at specified minimum prices to ensure production remains viable even during price declines. Agricultural price support programs provide historical precedent where governments established minimum prices for certain crops. However, implementing such programs for industrial minerals involves different considerations, including international trade implications, budget costs, and market distortion effects. No specific price floor level for silver has been officially announced or implemented as of the available information. Government statements indicating that such mechanisms are under development or consideration represent policy discussion rather than enacted policy. The distinction between policy consideration and policy implementation matters substantially for market analysis. If a price floor were implemented at a level below current market prices, it would have minimal immediate impact but would provide downside protection against extreme price collapses. If implemented at or above current market prices, it could provide direct price support but would raise questions about sustainability and budget implications. The effectiveness of such programs depends on the price level chosen, the commitment credibility, and the budget allocated to purchases. Inflation adjustment of historical prices provides context for comparing current price levels to previous peaks. Silver reached $50 per ounce in January 1980. Adjusting for consumer price index changes from 1980 to 2026 requires applying the cumulative inflation rate over that 46-year period. If cumulative inflation approximates 300%, the inflation-adjusted equivalent of $50 in 1980 would be approximately $150–200 in 2026 dollars, depending on the specific inflation measure used. This calculation provides perspective on whether current nominal prices represent real purchasing power peaks or whether previous peaks were higher in real terms. At $80 per ounce, current silver prices remain substantially below the inflation-adjusted 1980 peak. This observation is sometimes used to argue that silver has room to run to match previous real price levels. However, this argument assumes that prices should or will return to previous inflation-adjusted peaks, which represents a specific view rather than an inevitable outcome. The pattern of consecutive monthly gains represents a descriptive statistic about recent price behavior. If silver closed higher each month for 9 consecutive months through January 2026, and if February closes higher than January, it would establish a 10-month winning streak. Such streaks are relatively rare in commodity markets, where prices typically show more volatility and alternation between up and down months. However, streak continuation does not imply streak continuation probability increases. Each month's price movement reflects the supply-demand conditions during that month, rather than following a pattern determined by previous months. While momentum can persist, it can also reverse. The length of a winning streak provides no predictive information about whether the next month will continue the streak or end it. The January intraday spike above $116 followed by month-end close around $79 illustrates high volatility within the month. Intraday highs reflect the peak price reached during trading sessions, while monthly close prices reflect the final settlement price of the last trading day. Large gaps between intraday highs and monthly closes indicate substantial volatility and profit-taking or selling pressure following the peak. Multiple scenarios exist for how silver prices may evolve depending on geopolitical conditions, institutional demand, industrial consumption, and policy developments. Scenario A involves sustained strength with gradual appreciation. In this scenario, industrial demand continues growing driven by renewable energy expansion and electrification trends. Solar panel installations maintain growth trajectory, increasing silver consumption. Electric vehicle production expands, requiring silver in battery systems and electrical components. AI infrastructure development drives data center construction using silver in electrical systems. Investment demand remains positive as portfolio allocators maintain or increase precious metals exposure. Geopolitical conditions remain elevated, supporting safe haven demand. Government critical mineral policies provide supportive framework without distorting markets. Silver prices advance gradually toward $90-$100 over subsequent months with volatility but sustained upward trend. The gold-silver ratio compresses toward 50-55-1 as silver outperforms gold. Conditions required for Scenario A include continued renewable energy policy support, driving solar installations, sustained EV adoption growth, AI infrastructure investment maintaining pace, no major geopolitical stabilization reducing safe haven demand, and institutional forecast targets being met or exceeded. Indicators include monthly solar installation data showing growth, EV sales statistics maintaining trajectory, silver ETF inflows continuing, physical premiums remaining elevated, and lease rates staying above historical norms. Scenario B involves consolidation and range-bound trading. In this scenario, the rapid advance from $70s to above $100 creates need for consolidation. Profit-taking from investors who accumulated at lower levels creates selling pressure. Industrial demand grows, but at modest pace, insufficient to drive continued rapid price advance. Investment demand stabilizes rather than accelerating. Geopolitical tensions remain, but do not escalate significantly. Government policy discussions continue without near-term implementation. Silver trades in range between 75-90 over subsequent months without clear directional trend. Volatility remains elevated, but prices oscillate within the range rather than trending. The gold-silver ratio stabilizes near current 60-65.1 levels. Conditions required for Scenario B include industrial demand growth matching but not exceeding projections, investment flows stabilizing rather than surging, geopolitical conditions remaining stable without major escalation or resolution, and profit-taking balancing new buying interest. Indicators include ETF flows showing mixed patterns, physical premiums compressing from elevated levels, lease rates normalizing, industrial consumption data meeting but not beating estimates, and technical indicators showing consolidation patterns. Scenario C involves correction and retest of lower levels. In this scenario, the advance from $70s to above $100 proves unsustainable as it was driven primarily by speculative momentum rather than fundamental tightness. Industrial users reduce purchases as high prices encourage inventory drawdown rather than restocking. Investment demand reverses as profit-taking accelerates, and some institutional forecasts are revised lower. Geopolitical tensions ease through diplomatic progress, reducing safe haven demand. Technical support levels fail as selling pressure overwhelms buying interest. Silver declines toward the 64-70 range, potentially testing lower levels toward $55-$60 if selling accelerates. The gold-silver ratio expands back above 70.1 as silver underperforms gold during the decline. Conditions required for Scenario C include industrial demand, disappointing projections, investment flows reversing to outflows, geopolitical risk premium diminishing, technical support failure, and profit-taking cascade. Indicators include silver ETF outflows, physical premiums compressing substantially, lease rates declining towards zero or negative, industrial users reporting reduced purchasing, and breaking of technical support levels on high volume. The implications vary across participants. Industrial users of silver face input cost uncertainty regardless of which scenario unfolds. Continued high prices or further advances increase manufacturing costs, requiring either absorption through margin compression, pass-through to customers via price increases, or acceleration of substitution efforts. Consolidation or correction would provide cost relief, but introduces procurement timing decisions about whether to increase purchasing during weakness. Investment holders who accumulated silver at lower levels face decisions about position management. Those who purchase below $50 have substantial unrealized gains and must assess whether to maintain positions for further appreciation potential or realize profits after significant advance. Those who purchased during the recent advance above $80 have different risk-return profiles and may face unrealized losses if correction scenario unfolds. Mining companies producing silver as primary product or byproduct benefit from elevated prices through improved profitability. However, they face decisions about production expansion, capital allocation, and hedging strategies. Expanding production during price peaks risks creating excess capacity if prices subsequently decline. Hedging locks in prices but forgoes upside if prices continue rising. What remains uncertain includes the trajectory of industrial demand depending on renewable energy policy implementation and technology adoption rates, investment demand patterns influenced by macroeconomic conditions and portfolio allocation decisions, geopolitical developments and their impact on safe haven demand, government policy implementation regarding critical minerals support programs, mining production responses to elevated prices, and the sustainability of current price levels versus the likelihood of consolidation or correction. Key variables to monitor include monthly solar panel installation statistics, electric vehicle production and sales data, silver ETF holdings and flow data, physical market premiums and lease rates, industrial consumption reports from major consuming sectors, geopolitical risk indices, government policy announcements regarding critical minerals, mining production data, and technical price levels, including support and resistance zones. Changes in these indicators signal which scenario is developing. The mid-February price action showing recovery above $80 following early February weakness to $76 demonstrates continued volatility in silver markets. The gold-silver ratio near 62.1 sits within historical ranges rather than at extremes. Institutional forecasts projecting $81 to $100 averages for 2026 represent analyst views based on their models and assumptions. Government discussions about critical mineral support frameworks represent policy considerations rather than implemented programs. Historical inflation-adjusted price comparisons provide context but do not predict future outcomes. To summarize confirmed elements, silver traded above $80 in mid-February 2026, following recovery from $76 lows earlier in the month. Gold traded above $5,000 during the same period. The gold-silver ratio declined to approximately 62.1. JPMorgan analysts projected $85 peak and $81 average for 2026. Goldman Sachs projected $85 to $100 average range. United States officials made statements about developing critical minerals support frameworks without announcing specific implementations. January saw intraday spike above $116 before closing around $79. What remains uncertain includes whether industrial demand will match, exceed, or fall short of institutional projections, the trajectory of investment demand influenced by macroeconomic conditions, geopolitical developments affecting safe haven demand, the timing and structure of any government critical minerals programs, and whether recent price strength represents sustainable advance or temporary spike requiring consolidation. The variables that matter most include industrial consumption growth rates, investment flow direction and magnitude, geopolitical risk developments, government policy implementation, mining production responses, and technical price level behavior at support and resistance zones. These factors determine whether silver sustains above $80, advances toward institutional forecast targets, or corrects toward lower support levels. This analysis examines the documented price movements, institutional forecast methodologies, and policy discussions while presenting multiple scenarios rather than predictions about future outcomes. We will continue tracking confirmed developments in industrial consumption data, investment flows, policy announcements, and price behavior.